Now we have come up with session number 102, where we'll be discussing in detail about the corporate actions. So we'll be decoding the corporate actions on the stocks you hold. So there are n number of corporate actions. So it can be dividends, it can be bonus, split, buyback, spin-offs, offer for sale, mergers and acquisition, tender, offer, liquidation and dissolution, right issue. So these are all probably you might have heard only about dividend, but other things are also equally important for you to understand as you are holding the stocks in your portfolio, and many times you will have to act smartly so that you compound your wealth using the corporate actions available on your stock portfolio. So let's directly get into the topic. So what is a corporate action? It is basically an event agreed upon by company's board of directors and authorized by its shareholders like we, and that causes material changes to company's securities. So security in the sense stocks. So these are actually agreed upon by the shareholders and also by the company's board of directors, and there will be polls available. So you can poll, we can vote, and you can vote for the action which they are suggesting, and if it is majority, then they go ahead with that corporate action. Now first let's talk about the famous corporate action, which is cash dividend. So cash dividend, so or simply called dividend. So this is the way by which company distributes part of its profit earned by the company to its shareholders. So dividend is expressed on per share basis and is expressed with regard to its face value. For example, if the face value is 10 for a stock ABC, and its face value is 10, then dividend payout, say it is 2 rupees, means 2 by 10 into 100, it's like 20%. So it is not 2 rupees expressed in terms of the price of the stock, but it is expressed in terms of the face value. So face value is always small, so the percentage whatever they project will be high. So 20% dividend payout is like 2 rupees for a face value of 10, stock having a face value of 10. So after dividend payout, normally the stock falls to the extent of which the dividend is paid out, because it is coming from the book value and it is paid out. So that much amount, slightly there will be a fluctuation in the stock price, but later on it will catch up with the earnings trend of the stock. So I hope it is clear, and dividends will have its own taxation policies, which I am not getting into. Next comes bonus shares. So bonus shares, it's free shares from the reserves of the company given out by the company. Here only the quantity of the shares increases by respective ratio. Say if the bonus share is 1:1 or 3:1, 5:1, etc. So this price also reduces, the stock price also reduces based on the ratio, and hence the total value of the shares held by the investor or shareholder remains the same. So this is just to increase the liquidity and retailers' participation, as the small retail investors get attracted to the lower price stocks. In the sense, for an example, if the stock price is 100 rupees, and if a guy has got say 1000 rupees with him, so he can only buy 10 shares. But if the stock price is say 50 instead of 100, then he can buy 20 shares. So it is all perspective. End of the day, you are getting the particular percentage of the book value only, or the particular pie of the business only, but you can get liquidity, or more people will come in and buy if the stock value is small, as far as the small retail investors are concerned. So it is one for increasing the activity in the stock and liquidity and the price action in the stock. The company does that. And please don't confuse this stock price fall after bonus share as a market correction. It is normal to happen because your book value has been halved, and that has been given back to you. So whatever you hold as a piece of company remains the same, only the quantity increases. So this cannot be taken as a correction, because the value goes down, but the number of shares held with you also increases almost in the same proportion. So in bonus shares, the share capital increases, but the reserves reduces, and hence the book value, or I would say the net worth, remains the same, as I explained. Hope this is clear. Now next is stock split. So price reduces and number of shares outstanding increases. So this is all in the stock split. So this is again to increase the liquidity and retailer participation, as I told in the earlier bonus shares thing. And in stock split, unlike bonus share, both the share capital and the reserves remains same. The return on equity, ROE, of that share remains same post both bonus and even stock split. So that is all about stock split. Now, just like stock split, there is something called reverse stock split. So this is nothing but the reverse or the opposite of stock split. So in the reverse stock split, what happens is that it is a corporate action that combines a company's shares into fewer and more valuable shares. In fact, it increases the value of the stock in figure terms. In the sense, if the stock value is 100 rupees, so if it is 1:1, then the stock value becomes 200 rupees, which reduces the number of outstanding shares. If you see, the total value of the shares or the company's market capitalization will be the same after the reverse split as it is before the split, and except if the company pays out any fractional shares as cash. So a company normally does a reverse split to increase its share price or to prevent itself from being delisted from the stock exchange. For example, if you see, the New York Stock Exchange has rules that allow it to delist a stock that trades below $1 per share for an extended period. So to improve the stock value, the reverse split can be done so that the stock value goes up and they don't get delisted. Now getting into the next thing, which is share buyback, which is very common these days. You have heard that TCS had bought back their stocks many times at 4150 rupees, 4200 rupees, etc. So this creates value to the investors. So there are basically two types of buybacks. One is open market purchase and second one is FPO, which is fixed price offer or tender. So it's like company investing in itself, using its profits to invest in itself. So buyback normally will be at a premium to which the stock price is currently trading in the market. Say for an example, it is trading at 100 rupees. They may offer a buyback at 150 rupees, which creates an extra 50 rupees premium for the stockholders, which pays them off. Because if they are offered 100 rupees, then what is the point? Because it's already available in the open market. So some premium will be added upon the current market price so that the investors are rewarded properly. And also there is some cutoff, like if it is 1.5 minimum 1.5 lakh holding is there in the stock, then the buyback offer is more in quantity wise, and if it is more than 1.5 lakhs, it is considered as long-term investors. So they are given lesser number of shares because they are not interested in selling off assets, because they are long-term. They are considered as long-term investors. So there are various rules in that as well, which we are not getting into as of now. And what are the reasons for this buyback, which is very vital to understand. So one is improving the profitability, because your earnings per share, the ROE also improves as the buyback is done. And also return on capital to shareholders also increases. Now the consolidation also it consolidates their stake in the company, means the promoter holding in the company also increases as the buyback is done, which is considered as a very positive sign, because they are very clear about their future stock performance or the company's business profitability. So that is why they are confidently buying it back. Also prevent hostile takeovers. Like if the promoter is taking over the company in more percentages, means they are not allowing the other entities to gain power over their corporate actions or their investment rationales or their management decisions. So promoter has higher stake, then others will have lower stake. So decisions are mainly taken by the promoter holdings only. And this also shows, as I told, show confidence of promoters for the future aspects. And also it supports the share price, because if it is falling, if the share price is falling, if buyback is done, the promoter can get their own stock at a lower valuation, and they can buy back their stock at a lower valuation, so that they get the piece of the company or regain the power on the company at a cheaper cost. This one try was done by Vedanta, Anil Agarwal Group, wherein the stock, as Vedanta had gone at a very low price, they had tried to buy back, but it was not allowed. The investors didn't allow, because they were getting it at a cheap valuation. So facts like that also are to be considered. And also another thing is that to offset the employee stock compensation, ESOP. So this also buyback is done. Now another thing about this bonus share, going back to bonus share, is that bonus issue actually involves transfer of funds from the reserves, which includes the general reserves created out of profits and share premium accounts, to share capital of the company. A company with large reserves can look into reward the shareholders by transferring funds from the free reserves to the share capital. So this is one another hidden thing in the bonus shares. Hope this is clear to you. Now next thing is right issues. So right issues, this is another way by which a listed company can raise capital without incurring any underwriting fees. As it's already listed, no IPO can be launched So they can offer to sell the stocks to the existing shareholders at a lower price than current market price, and by which they will get some funding. So recently South Indian Bank also had done this many times. In fact, recently also I think they were trading at 30 rupees. They had done a right issue at 22 rupees. So at a 8 rupees discount, they were doing the right issue, wherein that much amount raised from the fund is used for their running the business or other business activities. So it's a privilege given to the existing shareholders as well to get the stock at a cheaper valuation. And also this helps the management to raise funds for their investment activities. Now next is the offer for sale or OFS. In the offer for sale, what happens is that it's a corporate action by which existing shareholders of a listed company, typically promoter, will sell or dilute the holdings through a exchange-based bidding platform, ensuring compliance with minimum public shareholding requirement and set as per security contracts regulation rules. So this is like open market, they will sell the stake. So this can be bought by a identified entity or by the retail investors as well. So this is like again for raising the funds in the by selling the promoter stake in the company. Next one is mergers and acquisition. So mergers and acquisition are business transaction in which the ownership of the companies are transferred to or consolidated with other companies. Say in case of Grasim, I remember that Grasim and Aditya Nuvo. So these companies were separate listed entities and they got merged. If you see, I was holding Grasim at that time and still I am holding Grasim, and at that time while the Aditya Nuvo and Grasim had merged, every Grasim holder had got huge amount of Aditya AB Capital shares. So that also got listed in the market, and good number of shares of Aditya Capital, AB Capital, was also allocated in free to the Grasim shareholders. Though there was a dip in Grasim shares, again the Grasim shares after the merger increased in value, and I am sitting at good amount of profit currently as I speak. So when two companies merge, that is joined into one, the shares of one company will be automatically be exchanged into the shares of the other company at a fixed ratio. So that's all about mergers, and obviously similar to acquisition as well. It is like different company will be acquired by the other company to improvise their business transaction or the business profitability. To kill the competition also, people do this. Now the next one is tender offer. So it's a public open offer or invitation by the promoters. So basically it will be given in public ads, especially in newspapers, etc., by a prospective acquirer to all stockholders of a publicly traded company to tender their stakes at a specified price during a specified time frame. So offered price will be normally higher than the current market price and a premium to attract selling. So promoters of the company may or may not have endorsed the tender offer proposal. That's also to be considered. But if it is like an hostile takeover, so somebody has to take over some good portion of the company stakes, so they can do this. And if the stakeholders are able to sell this and they are willing to sell, they can take it. So one thing correction here is that the public offering or invitation through ads will be for a hostile takeover from non-promoters. So promoters will not sell their stake. So if there is a good public holding, so the prospective acquirer can buy it from the public, not from the promoters. So it will be a non-promoter based transaction. The promoters will not be selling in this. Hope this is clear in the tender offer. Now the another one is spin-off. So a spin-off is an independent company created when a parent company issues shares in an existing business or division to parent company shareholders. So normally spin-off is done by parent company when it anticipates or projects that a new independent firm will be worth more than where it was part of the parent company. A spin-off will have its own management, new name, but still it may continue to receive financial or technical guidance from or support from the parent company. So normally spin-off tend to be a good investment for shareholders for sure. So there is something called subsidiary spin-off. So that is what I mentioned, that in a spin-off, in a subsidiary spin-off, a spin-off will have its own management, new name, but still it will continue to receive the financial or technical aid from the parent company. And also a parent company may spin off 100% of the shares in its subsidiary, or it may spin off 80% of the shareholdings and hold a minority stake of maybe less than 20% in the subsidiary. So this is also a part of corporate action through spin-off. Another point is liquidation and dissolution. So in this process by which a company sells off its assets and close down its business for good, the proceeds of this sale are to pay off any creditors as possible, and dissolution is the last stage of liquidation in which the assets of the properties of the company are redistributed. Secured bond holders gets paid first, then the if you see the common stockholders that are us are the last in the line for any distribution of the proceeds. So that is very common that all the bondholders, secured bondholders, or the lenders will be paid first, and the stockholders like shareholders will be the equity holders will be paid last. So that's one part of it. So that's all about corporate actions. So various corporate actions we have discussed here. So hope this is very clear to you. So uh, see you in next video. Hope this session was interesting and understanding for you. If you have any comment, please feel free to comment in the comment box. Do follow us, follow the posts of our community session of the YouTube channel, so that you get regular insights on the what is happening in the market, or the various investment opportunities which is available in the market. So hope this session was useful to you. See you in the next video. Till then, happy investing.